I think that the preferred stock market is really an interesting place right now to be, for sure, because rates are higher than they've ever been. So typically, in the preferred stock market in the past, you would be taking an inordinate amount of risk, essentially, and effectively be holding stock of a company because you were very subordinated in the capital structure, but you weren't privy to the upside. You would just get that dividend, and obviously the preferred would float around, and that preferred, whether it be a bank or any other company, but typically the banks were the ones that were issuing these. They would be such that they would float around quite a lot, not as much as stock, more than a bond, right? So you're somewhere in that mid range, and people would do this to effectively get additional income, especially because interest rates were so low. And so I saw these being used, like I've been in finance now since 2008. And so these were definitely used as interest rates got lower and lower and lower. People started adding these to their portfolio, even though they weren't necessarily right given their risk profile. But now, right, because people are mispricing the risk in the market of what they think Bitcoin is going to do, like Strategy and Strive are now having to issue these at much higher interest rates, and so they look a lot more appealing. And in fact, on a risk adjusted basis, they actually do better than stock, right? Because if you look at stock over the long term, stock is only effectively going to yield about 7% in real terms. Which, if you translate that with an inflation adjusted rate, it could be anywhere between 8 and 14%, but obviously moves around quite a lot more. And so if you're looking at that apples to apples comparison between that and something like Stretch or SATA, you could see obviously why people would want to hold something that doesn't fluctuate as much, where they'd have more access to their cash in any given period of time and be able to take on that higher yield. And yield is worth more in the near term. So one of the reasons why people like bonds so much is because they get paid, right? And then they have a guarantee of their money coming back at some period of time. And people weight that more towards, like, it's less risky because I'm getting paid. And it's the same thing, right? If dividend yields in stocks are very low, which they typically are, right? They're highest being maybe 2% that you're going to get in even a value company, versus like literally getting 10 to 12% in your hands on a monthly basis. Obviously 1% a month if it was 12%, that like your risk is much lower on a risk adjusted basis because you're getting that cash sooner.